Good afternoon, and thank you for attending. My name is Si Win Yi from the Yi Real Estate Network, and I'd like to take this opportunity to share with you a video on the most vulnerable and least vulnerable real estate markets in the country per adamresearch.com, adamdata.com. So before I will share the screen to go over the article, I'm going to share with you that personally, I have been a real estate investor for more than 30 years, and I have purchased investment properties in many parts of the country. And on a professional level, I own a real estate investment club that for the past 20 years almost, and I've been helping real estate investors from anywhere in the country and in the world for that matter to buy in the best affordable markets, the best cash flow markets, turnkey types of investment properties, all professionally managed by professional managers. So people can invest wherever they live at, whether it's a high cost area or whatever in the country, they can buy remotely, passively, and to excellent markets so they can invest for the long term so they can achieve their financial goals. All right. So again, over the years, we have connected with so many local turnkey providers throughout the country, and also with builders, with local builders in those markets that work with investors so we can find the best deals possible for our turnkey real estate investors. So without further ado, let me share my screen and go over this article. Came from adamdata.com, and the headline, the title is California, New Jersey, and Illinois again dominate the list of vulnerable housing markets. By the time I finish with this video, real estate investors out there will be able to make an informed decision, do their own further research to determine where is the best markets to purchase investment properties. And also, primary homeowners can learn from this video education-wise, so they could potentially, if they want to, move to a specific area that they want to live in for the long term as a primary homeowners. All right. So without further ado, Adam Research is what they have done is they have released a special housing risk report spotlighting county-level housing markets around the U.S. that are more or less vulnerable to declines based on home affordability, unemployment, and other measures so far in the second quarter of 2022. All right, and then the second quarter patterns based on gaps in home affordability, underwater mortgages, foreclosures, and unemployment revealed that New Jersey, Illinois, and California had 33 of the 50 counties that are most vulnerable to potential declines. All right. And then the next thing that is my takeaway is that at the other end of the risk spectrum, the South and Midwest had the highest concentration of markets considered least vulnerable to falling housing markets. Good to know, isn't it? Just to take a step back, the big picture, many of you already heard, but I will repeat this, what's happening with the pulse of the real estate market from a high level, in that the Federal Reserve has promised to be as aggressive as it needs to be in order to get inflation under control, even if its actions lead to a recession, said Rick Sharga, Executive Vice President of Market Intelligence at Adam. Okay, so he further stated, given how little progress has been made in reducing inflation so far, the Fed's actions seem more and more likely to drive the economy into a recession, and some housing markets are going to be more vulnerable than others if that happens. Okay, and another paragraph which I really want to highlight is the counties were considered more or less at risk based on a percentage of home facing possible foreclosures and a portion with mortgage balances that exceed estimated property values, the percentage of average local wages required to pay for major home ownership expenses on medium priced single family homes, and local unemployment rates. Okay. And the conclusion is that the sale and of both existing new home have declined as mortgage rates have doubled to 6% right now over the past year, and inflation remains a 40-year high. However, these most recent risk gap do not suggest an imminent fall in housing markets anywhere in the country. Okay? In fact, many homeowners have vast amount of equity, and home sellers also are profiting from the rising housing prices. So it's not all doom and gloom. The people that own a home these days in the country, 40% of the homeowners have no debt. They own the home free and clear, and the other 60% of the homeowners that have mortgages, they have substantial equity in their homes because they have what they purchased prior. They purchased with 20 to 25% down payment, most of them. And of course, during the pandemic, we have seen record home price increases. So homeowners these days are in a great position, and there are very little risk of a housing crash based on what's going on, as I stated so far. So furthermore, we are still historically at a tight supply of properties. So this means the level of inventory available out there is still very low in relationship to the pent-up demand as we speak. The most vulnerable counties clustered in the Chicago and New York City and Philadelphia area, along with the sections of California, where I live in the San Francisco Bay Area for more than 30 years, and I've seen the cyclical nature of California real estate market. So we're going through a little bit of a correction in California. So it seems that California leads the way in up and down of the real estate cycles. And of course, obviously, I've been through various cycles up and down, and survive and thrive all these real estate cycles. And you guys out there also should take that philosophy. Just buy and hold over long term. Don't go through the short term volatility situation, and stay the course and invest for the long term. So that's my philosophy. Always has been, always will be. So and speaking of California have 13 counties in the top 50 as a at-risk scenario, right? Based on the factors we just discussed. And they're located throughout California. Mainly, most of it are away from the coast. They are in Northern California. They are in the Central Valley areas, like 1 to 2 hours away from the coast of the San Francisco Bay Area. In Southern California, are mostly in the inland valley or Central Valley of Southern California as well. Also among the 13 counties in the top 50 in the nation with the highest risk situation. So counties that are most at risk have a higher level of unaffordable housing, underwater mortgages, foreclosures, and unemployment. But having said that, only 7% of mortgages were underwater in the second quarter of 2022. So for that reason, I do not foresee any type of a foreclosure crisis moving forward, because there's such a small percentage of the U.S. homes are under stressful situation as we speak. So, and let me see what additional takeaway I should discuss with you. Nationwide, only 1 in 1,500 or so homes were in a position of that are potentially facing a foreclosure situation. So it's a very, very, compared to the 2008 housing crash is today is so much different than the 2008 housing crash, where there was oversupply of homes available at that time, and people underwater, people obtaining mortgages at that time with no documentation loan, so 0% down, and anybody that can fog a mirror can obtain a homes back in 2008. Today's is very different. Risk home lending is very stringent. Only the most qualified buyers in today's times can qualify for a mortgage, and they have to have some skin in the game, 20% down, what have you. All right, so very different market. And so let's go, now that we have discussed the high risk areas in the country, so let's go over the counties that are less at risk, and they are located in the south and Midwest. So 25 of the 50 counties that are showing less vulnerable to housing market problems, or 14 of them are located in the Midwest. And Tennessee, which is not surprising, it has 6 of the 50 least at-risk counties. All right, and then the other areas are located in the South, which is mainly South, which is Texas, Florida, Georgia, Alabama, and North and South Carolina. Those southern states show the least at-risk areas of the region. All right. So let me see what else I need to go over. And again, so my takeaway is this: of course, our investors are mostly investing in the South and Southeast, because not only they are have a low risk profile, but it is affordable markets. The price of homes is still relatively inexpensive compared to the other part of the country, especially in the West and Northeast. So yep. So the takeaway again is that now that you hear this part of the information from Adam research, in that as a risk investor, focus in areas that have least amount of risk, that have an affordable factor, and that have a good job growth, good population growth, and the areas that have a lot of renters. We are becoming a renters nation. So as an investor, buy a least affordable home in the South and Southeast, the least risk, and have a good rental market where skyrocketing of rents allow investors to cash flow even more than in the past. So that's my takeaway. So hopefully you have learned a lot from this information. The takeaway is that yeah, a lot of high risk areas are in California, and some in the northeastern part of the U.S. and the Midwest and Chicago area, and most of the low risk areas are in the South and Southeast, and located in the Sun Belt, South and Southeast. Cash flow properties for a great opportunity for investors during these challenging times to take advantage of this kind of information and take action. All right. So hopefully if you receive value from this video, please click the like button, and also subscribe to my YouTube channel. And third is for you to sign up to become a free member of our Real Estate Investment Club, the Real Estate Network, and sign up on our newsletter. So when you sign up for our free newsletter, you have an opportunity to learn more about very specific real estate investment opportunities in the South and Southeast, coincidentally. All right, thank you so much and also please place a comment on below and see where I'm curious to hear what you think, and I'll be more than happy to also to respond to some of the comments that you made. And so thank you so much for attending. My name is Si-Win Yi from the Real Estate Network. Have a nice day. See you on your next video. Bye-bye.